So let's talk about some real estate and how to buy your first rental property. A step-by-step process of everything you need to know and everything that you need to do so that you can actually buy your first rental property, start building that passive income, and eventually creating financial freedom for yourself. This is the same step-by-step process that I've had to go through for the last 20 plus properties that I've purchased for rental properties or property flips. Now, if you're new to my channel, welcome. My name is Shaun. I am a life and finance coach, helping you create the breakthroughs needed to go from where you are to where you want to be financially. But let's go ahead and dive into those step-by-step strategies of everything you need to know to buy that first rental property. So the very first thing that we have to do in order to buy a rental property is have enough money for a down payment. As a general rule of thumb, you're going to need between 20% and 30% down payment for your rental property. Now keep in mind, if you're buying your personal home, you could get by with as little as 3.5%, but when it comes to an investment property, you are going to need at least a minimum of 20 to 30% on average. Now, there are a lot of strategies and advanced finance techniques that allow you to acquire properties with no money down, owner financing, land contracts, and things like that. However, in this video, we're going to go through the more traditional route, as that is usually how most people are going to start. According to the Federal Reserve economic data, the median price of a home sold in 2022 was about $428,000. So if we were to take that $428,000 and calculate 20% of that, that would leave us with an $86,000 down payment needed in order to buy your median home for a rental property in the United States. Now, of course, your area may be way more expensive, it may be less expensive, but regardless of the price, be sure to go online and see what the average home for a rental is costing and take about 20% of that. Now, if you don't have the down payment currently, then I highly suggest that you start looking at your budget and figuring out how you can start saving money and or making more money. Now, I'm not gonna go into a lot of detail in this video on budgeting, but I do have some really incredible videos on exactly how you should budget or how you should manage your money the right way using a 50-30-20 rule. I even have some really cool videos on how to save $9,000 fast. And these are just some really cool tips and tricks that I've used over the years to help me save a lot of money very quickly. So I'm gonna leave some links below in the description box to those videos. So this brings us to our next step, which is to get your credit score up. If you're like most people probably watching this video, you're not gonna be paying for this house in cash, which means that you're going to need to be able to qualify for a loan in order to make the purchase of this rental property. Having really good credit is very, very crucial, not only in your ability to obtain a loan, but it will also help you maximize your profits and save you tons of money over the years due to having the lowest interest rates possible on a loan. According to Experian, you should be aiming for at least a 620 credit score. However, if you really want to maximize the loan benefits, getting the lowest interest rates possible, you really should be aiming for at least a 740 or higher. It's going to save you tens of thousands, if not hundreds of thousands of dollars. So it's really important to have great credit. Let's use this example, for instance. Let's say that we have two different people looking to get a $250,000 loan over the next 30 years. Person A has okay credit and is able to get an interest rate of 5%. A $250,000 loan at 30 years and 5% interest would give you a monthly payment of $1,342 per month. And their total interest payments over the life of the loan would be just over $233,000. Now, let's say person B has really great credit, and instead of paying 5%, they only have to pay 4% on their loan. Their overall mortgage payment would be $1,149 a month, and the total interest paid over the course of the loan is just over $179,000. So just that 1% difference in interest rate is a difference of $53,000 to $54,000 over the course of the loan. Now, if you don't have really good credit right now, then I highly suggest you check out some of my videos on how to get a perfect credit score very, very quickly. I'll leave some links below in the description box for that. Now, this brings us to the next step of the equation, which is getting your tax returns in order. Now, like we mentioned, if we're going to have to get a loan, we're going to have to get qualified. And one of the most important things in qualifications outside of your credit score are your tax returns. The whole point of showing your tax returns is to help lenders see that you have really good stable income and that you are more than likely able to pay the monthly payments on the property for the course of the loan. Now, of course, this is going to be a rental property and ideally your tenants are going to be paying for it. But even with that, the lender is wanting to know that you are able to make payments in case if you don't have a tenant or a tenant doesn't pay. Lenders lenders love people who are W-2 employees or salaried employees. So if you are, you're gonna be showing your last 2 years tax returns, and they're going to take an average of those 2 years, and that will be what's considered your yearly income. Now, if you're like me and have your own business or an independent contractor, or you're more of a freelance worker, it gets a little bit trickier. They're still gonna wanna see 2 years tax returns, but they may put other variables into the equation. Now, the most common question that people ask at this point is, well, how much money do I need in order to qualify for a loan? And there is no exact amount of income needed to qualify for a loan. However, we can use what's called the 28-36 rule, which will help give us a very general idea of whether or not you would have the possibility of qualifying for a loan. The 28-36 rule states that the mortgage on your rental property should not exceed 28% of your gross income, and that your debt to income ratio should not exceed 36%. This is not a steadfast rule. So it's not like just because you fit this criteria, you're guaranteed to get a loan. And it doesn't mean that if you don't fit this criteria that you have no chance of getting a loan. The only way you're truly going to know is by going to a lender or multiple lenders, presenting your information, and seeing if they let you qualify. Now, as a pro tip, be sure to check out multiple lenders, and that is because there have been many instances where one lender did not qualify me, but by going to another lender, it actually did. And that is because different lenders have different qualifications. Some are a lot more strict, and some are a lot more flexible. And for me, being an independent contractor, having my own business, I have to find lenders who are a lot more flexible in their approval process. Typically, lenders will use about 75% of potential rents as income when looking at qualifications for you and your loan. Now, if you haven't done so already, please be sure to smash that like button, hit the subscribe button if you're finding value in this video. I greatly and sincerely appreciate it. Now, this brings us to our next step, which is looking for properties and assessing cash flow. One of the things I learned very early on in my investing career is that just because you invest in real estate doesn't mean it's a good investment. The single most important thing you can do when assessing a rental property is looking and assessing if it's going to cash flow or not. While appreciation is absolutely awesome, and that's one of the advantages to investing in real estate, what you want to do is make sure that you invest for cash flow. And this is where real estate becomes very advantageous. Now, I have a very detailed video that I just released recently on how to assess cash flow on a rental property and how to break it all down. So I'm going to leave a link below in the description box. What you need to be doing is going on to places like realtor.com, it could be Zillow, getting an idea of what general property values are, and then also getting an assessment of how much you can rent these properties for. This is really important because to really assess if a rental property is good or not, you need to know what a competitive price is, how much you could rent that out for. You're going to need to know what the general expenses are going to be for that property, and it's a simple math equation at that point in order to figure out if you are likely to cash flow or not. Now, as a pro tip, make sure you look for what's called a wedge deal. And a wedge deal is a property that you purchase for under market value because it needs a bit of work, but by doing so, not only do you get equity or profit right away, but once you do fix it up, you actually earn even more profit. Now, this brings us to our next step, which is to make offers on properties. So now that you've actually been going through and you've been assessing rental properties, you've been seeing whether or not they cash flow positive, what you want to be doing now is actually beginning to put offers on the table. You're probably going to need a real estate agent, so make sure you've partnered with one that you really like and trust, that has a really good experience and history in the real estate markets for investment properties. Do not get discouraged if your offer gets turned down. It's very, very common, especially in today's market where it's highly competitive, that you may have to put in 1, 3, 5, 10 plus offers on rental properties before one of your offers get accepted. In fact, just recently when I bought my own personal home, I got bidded out by quite a few different people on different properties, and it wasn't until the third or fourth property that I put an offer in on that I finally actually got the bid. Now, this brings us to the next step, which is to rent out the rental property. Now that you have your rental property, you've fixed it up a little bit if need be, it's time to rent out that property and start collecting that cash flow. Now, in some cases, you may have actually purchased a property that already have tenants in it, and at that point, you're just going to take over the management portion of it. But there will be other times that you buy a property that it's completely empty, and you're going to need to find tenants so you can start renting it out and getting that cash flow. Now, there's a lot of ways in which you can go about finding different tenants. There's all kinds of websites that help you rent a house. You could also use a real estate agent to help you find a tenant, or you can use property management companies. If you're using professional services such as real estate agents or property management companies, more than likely they're going to charge a fee, and it could be a monthly fee or it could be just a flat rate percentage overall. Now, all the rental properties that I have are out of state, and so I have to hire people in order to help rent out my properties, but I do field the phone calls, I do post the listings and things like that. Now, I have to say that buying rental properties can be super rewarding, and it's really fantastic way of getting that good passive income without having to put a lot of extra work into something. Yes, it's going to require more work than investing in things like ETFs or index funds like I talk about on my channel. However, you can get much higher returns when you know how to invest in rental properties the right way. Now, if this video gave you some value, please be sure to smash the like button, hit the subscribe button, that little notification bell. That way you can get all my videos on personal finance, investing, entrepreneurship. Also, be sure to check out some of my other videos on real estate, saving, and investing. But let's get out there and let's build that dream.